So, so 648 points in 2025 is not the same as 636 points in 2002, right? Because the Dow is much bigger now than it was back then. Now it's 45,000. In 2002, maybe, I don't know, it was maybe less than 10,000. I don't know what it was. We can look at the chart if you want. If you come now, a better indicator of the market is the S&P 500. That's value weighted. That means heavier weighted companies, bigger companies, big bulky fat companies like Nvidia have a greater weight than tiny little companies, right? With high stock prices. So the value weighted average says that the market's down 1.1%. That's slightly less bad, but the Dow being down 74 points with the S&P there right now the number for the S&P is 6,598. It's down 73 points. That's still over 1%. A 1 percentage point drop in the market is still a big deal. So I'm not saying that the market's not down or it's not bad. I'm just saying that there's different ways to measure that. The NASDAQ, which tends to be very tech heavy, that's down 1.5%. That's down by more than the S&P and the Dow. Why is the NASDAQ down more? Well, because tech stocks are getting their asses kicked right now. Tech stocks are taking a beating largely because they're taking a beating because they've been eaten. They've taken a beating because there you go. There's bars for you. They're taking a beating because they've been eaten. If you go look at a lot of tech stocks, um, let me see, AIQ. Let me AIQ is my favorite AI ETF, AIQ. So look at AIQ. Okay, so the tech stocks AIQ is down as expected by 1.67%, and it has lots of companies like Nvidia and Microsoft and stuff in it. But if you go back 6 months, AIQ has been on a hell of a run, 18.9%. That's amazing. Year to date, 26%. Over the last year, 28%. Last 5 years, 92%. Right? Pretty good. So, while you might look here and see that it's down and feel like that's a bad thing or that that's some sort of reckoning for artificial intelligence or an indicator that we've hit some sort of nasty AI bubble, I would encourage you to rethink that. I don't think it's an AI bubble indicator. I think it might mean a cooling off period. It might just say, hey, okay, you kind of got ahead of yourself. We're still going to make this money. It's still going to be massive. We just have to not overvalue massive because a lot of times what people forget is that the quality of your investment really comes down to your price you paid. You know, if you overpay for a good company, that's not a good investment. But if you underpay for a bad company, that could be the best investment you ever made. Okay. All right. So let me look here and look at more of your questions. What is dollar cost averaging and how do you protect and buy a portfolio? So King made dollar cost averaging is a beautiful way to make money because dollar cost averaging allows you to lower your average buy-in price over time, right? So ultimately, what happens is that we buy a stock at a certain price, we see the price drop, and we're sad about that, right? But dollar cost averaging means you're not just buying when times are good, you're buying even deeper when times are bad. So if you commit yourself, like I'm going to invest $100 a week in this stock or $100 a month in this stock, and I'm going to do it consistently, then if you're consistent and the stock is going down, that means that when the price is down, you can buy more shares than you could when the price is up. So remember that an up market is not always good, or a down market. It's really a matter of perspective. So an up market is good for the stocks you already own, okay? But a down market is good for the stocks that you don't own yet. So if you're really looking to kind of play this whole buy the dip game and make the market work, then maybe when the market is higher, you should be more of a seller, not selling your stock. Maybe you're selling options or something like that, or maybe sometimes you would sell some stock. When the market is down, you want to go shopping.